The number is $500,000. Not a million, not two, $500,000. And the reason I'm saying it up front is that most people blow past this threshold without noticing, and then spend the next decade doing the exact same things that worked at $50,000, applying them to a portfolio that is now large enough for those same habits to quietly cost them a fortune. The math doesn't warn you, it just changes. This is not a video about discipline or long-term thinking or staying the course. You know all of that already. This is a video about the specific, measurable ways that intelligent, disciplined investors, people who already did the hard part, end up hemorrhaging money through habits they built when their money was small and never updated when it got big. There are three things you need to stop doing once you cross $500,000. Not slow down, not reconsider over a glass of wine. Stop because the physics of your money has changed, and the habits that built the ship are now keeping it from sailing. The central idea I keep coming back to when I think about this inflection point is the difference between a speedboat and a cargo ship. Hold this metaphor. It is going to show up everywhere. A speedboat runs on speed, agility, and aggressive maneuvering. You dart, you pivot, you take the waves head on. That is exactly what you need when you are building from nothing, because the cost of inaction at small portfolio sizes is massive, and the reward for smart aggression is real. But at some point, and $500,000 is roughly that point, your vessel changes. You are now a cargo ship. You are moving serious weight. You have real exposure. And the tactics that made the speedboat win, the darting, the pivoting, the constant course corrections will destroy a cargo ship. Cargo ships do not win by going fast. They win by going consistently, minimizing drag, and staying on course. In a few minutes, I'm going to show you why the most expensive financial mistake most investors make is not losing money in a crash. It is what happens during perfectly calm years with no bad news and a healthy bull market. But before we get there, let me tell you exactly why the first habit should have a retirement party. Stop trying to beat the market. I know how this sounds. You have probably heard this advice before, dismissed it, decided it was for people who do not do their research. I am not going to disagree with you on principle. I am going to show you what the data looks like when you zoom out. And then I'm going to show you why it applies differently at $500,000 than it did at $50,000. There is a guy calling David who builds a $350,000 portfolio over his 30s through boring, disciplined, largely automated index investing. He sets up automatic contributions, rebalances once a year, ignores the news, mostly works. Then somewhere around 350,000 something shifts in his psychology. He starts feeling like he has earned the right to be more sophisticated. He opens a separate brokerage account specifically for satellite picks. A little sector rotation here, an earnings play there, a small cap ETF that his friend mentioned, an actively managed fund run by someone who was on a podcast. He tells himself this is sophisticated diversification. He spends 6 to 8 hours a month on this. He feels productive. He feels like he is doing the work. Here is what is actually happening to David. Over the past 15 years, 89.5% of actively managed U.S. large cap funds have underperformed the S&P 500. That is not one bad decade. That is the overwhelming systematic, durable result of professional fund managers with Bloomberg terminals, research teams, quantitative models, and track records longer than David's investing career, trying to beat the index and failing most of the time. And the recent data is worse, not better. From July 2024 through June 2025, just 33% of active strategies survived and beat their asset-weighted average passive counterparts, a drop of 14 percentage points from the prior year. David is not competing against retail traders. He is competing against those professionals, and those professionals are losing 90% of the time. David does not have their infrastructure. He does have their confidence, which turns out to be the most expensive item on the list. But here is the reversal that changes the whole frame. You think the problem is stock picking. Actually, the problem is behavior. There is a distinction between the returns the market delivered and the returns the investor actually captured. And that gap is wider than almost anyone accounts for. A Morningstar study found that the average investor has trailed the funds they actually invest in by approximately 2.5% per year due to poor timing. Read that again. Not because they picked bad funds. The funds performed fine. The investor bought in late after a run-up, got spooked after a pullback, moved to cash at the wrong moment, came back in after the recovery. 2.5% per year gone not from bad strategy, from bad timing. On a $500,000 portfolio, 2.5% is $12,500 a year every year. Not from volatility, from the behavior of watching too closely and touching the wheel too often. Over 20 years of compounding at 7%, that behavioral drag costs somewhere between $300,000 and $400,000 in foregone growth. A speedboat brain still trying to dart and pivot inside a cargo ship body. The hull cannot handle the turning radius. The engine is burning twice the fuel to cover half the distance. The goal above $500,000 is not to find the next great investment. The goal is to stop destroying the compounding you have already started. These are genuinely different objectives. Accumulation rewards aggression. Compounding rewards restraint. The investor who understands this before hitting $500,000 does not lose a year readjusting. The one who does not understand it pays for it indefinitely. By the way, if you find this kind of analysis useful, hit subscribe. YouTube's algorithm will not reliably surface this channel to you without that signal, and I put a significant amount of research time into these to have them disappear in your feed. Now, let me get to the one that costs more money per year than the other two combined, and that almost nobody catches because it is expressed in a percentage instead of a dollar figure. Stop paying percentage-based fees on a large portfolio. Here is the mainstream financial betrayal. Not conspiracy, not fraud, just a fee structure designed to be evaluated in percentage terms, because percentages feel small, and because the industry that invented this structure benefits from you never doing the dollar conversion. 1% doesn't sound like much. It sounds like less than your morning coffee. It sounds like less than sales tax. Here's what it actually sounds like when you run the math. Take a $1 million portfolio growing at an annual rate of 7% over 30 years. A 1% fee could shrink your portfolio by about 25% over that period, translating to nearly $1.9 million less on a $1 million investment. $1.9 million from a fee that is described as 1%. It is not 1% of a million that you pay. It is 1% of a growing compounding portfolio every year in perpetuity, without the service improving proportionately as the number grows. And this is the structural injustice of percentage-based fees at portfolio scale. As your investments grow, the fee grows too, even if the work your advisor does stays exactly the same. Think about what that looks like in real numbers. The work your advisor does for a $3 million portfolio is not 12 times harder than for a $250,000 portfolio, but the fee is 12 times higher. There is a marina in my head that I think about when I explain this. It charged boats a docking fee based on the weight of the cargo. Made perfect sense when all the boats were roughly the same size. Then a shipping company brought in an actual cargo ship. Suddenly, the marina was collecting more from that single ship than from everything else combined. Was the dock longer? Was the service better? Did anyone spend 12 times more effort? No. The number just scaled with something that had nothing to do with value delivered. That is percentage-based financial advice applied to a large portfolio. And the compounding on that fee drag is not linear. It is exponential. Imagine a $500,000 portfolio growing at a steady 7% annual return. Over 25 years without any fees, this portfolio could grow to approximately $2.71 million. However, with a 1% AUM fee, the portfolio would only grow to about $2.15 million, a difference of $560,000. $560,000. Not from a crash, not from a recession, from a fee structure that seemed perfectly reasonable when the portfolio was small and scaled, without mercy as it grew. And that is before you factor in the fund expense ratios that advisors layer on top of their AUM fee, which range from 0.05% to over 1%. So you might be paying a blended total of 1.5%, 1.7%, even 2% align on a portfolio large enough for those fractions to represent real 4 and 5 figure annual costs. Here is the reversal I need you to sit with. You think your primary financial risk is market exposure? You think about crashes, recessions, corrections. You do not think about fee drag because it does not appear on a single day where everything is down. But market risk is something you can ride out. Every crash in American market history has eventually recovered. Fee drag is something that never stops. Market risk works against you in bad years. Fee drag works against you every single year in bull markets and bear markets, compounding the opposite direction of your wealth silently, reliably, and permanently. The dollars you pay in fees represent potential future gains you will never realize because they are no longer invested. A dollar lost to fees today is not just a dollar gone. It is a dollar that could have doubled or tripled had it remained invested. Here's something I rarely see acknowledged publicly: the fee structure that is most punishing to large portfolios. The percentage-based AUM model is also the one most commonly sold during the exact moment when people feel successful enough to deserve professional guidance. The person who just hit 500,000 feels like they have earned real advice and the industry is there to sell it to them at precisely the moment when the math starts working against the buyer. Now, knowing these numbers and actually building a system around them are two very different things. I have had all of this data for years. It did not change my behavior until I built a specific framework around it and committed to it structurally. I spent months reading through 50 years of retirement data, the kind of research buried in academic journals, Federal Reserve working papers, and SEC filings that most people never reach, and distilled it into a digital book called The Exit Code. 8 chapters of pure research, no filler. I want to highlight 2 things that connect directly to what we have been discussing today. The first is something I call the dynamic withdrawal method, which replaces the rigid 4% rule with a flexible, mathematically grounded framework that accounts for your actual fee structure, your equity allocation, and the sequence of returns risk that makes early retirement the highest risk period for any portfolio. To give you a sense of why the standard rule is broken, Morningstar's 2025 retirement income research suggests that 3.9% is the highest safe starting withdrawal rate for retirees seeking consistent inflation-adjusted spending, assuming a 90% probability of having funds remaining at the end of a 30-year retirement period. That rate shifts significantly depending on when you retire and what fees are eating your compounding. The dynamic withdrawal method in the book accounts for all of that. The second thing I want to flag is the lazy portfolio framework. The historical evidence that a simplified low-friction portfolio has outperformed actively managed accounts over 30-year windows. Not by picking better investments, but by spending less on fees, generating fewer taxable events, and avoiding the behavioral drag that costs most investors 2+% annually. You can get the exit code for less than a dinner out through the link in the description below, and I will keep moving because the third thing is the one that will surprise you the most. And it is particularly relevant if you have been doing everything right, paying attention, following good financial advice, and growing your portfolio responsibly. Stop over-diversifying. Wait, every financial advisor ever told you to diversify? I know. Here's the thing they are right about diversification. The version they are not warning you about is called Diworsification, a term Peter Lynch coined decades ago. And it describes what happens when intelligent, anxiety-prone investors with significant money start adding investment vehicles not to improve returns or reduce genuine risk, but to soothe the psychological discomfort of having a lot to lose. This is not an exotic problem. This is extremely common above $500,000. Let me describe what it looks like. You have a clean, functional 3-fund portfolio: Total Market Index, International Index, Bond Index. Then you read about factor investing. The research on small cap value is compelling. You add an ETF. Then international equity looks undervalued relative to US. Equities, you add a separate international developed markets fund. Then a friend who works in real estate tells you REITs are a different asset class. You add a real estate investment trust ETF. Then you hear an interview with an economist about inflation concerns. You add a commodities ETF and a gold position. Then you want dividend income, dividend growth ETF. Then you realize you have two S&P 500 ETFs from two different providers because you opened a second brokerage account at some point. You now have 17 positions. Congratulations. You feel diversified. Here's what you actually have. You hold too many similar or overlapping investments, resulting in unnecessary complexity without meaningful risk reduction. Instead of improving performance, excessive diversification dilutes returns, increases costs, and makes portfolio management harder. And the overlap data is genuinely alarming. Research indicates that 60 to 70% overlap is common among funds in the same category. Those 5 different large cap funds you own, odds are they share 60 to 70% of the same underlying stocks. You have not diversified. You have bought Apple, Microsoft, and Nvidia 5 times in 5 different packages with 5 different fee structures and convinced yourself it is strategy. In extreme cases, an over-diversified portfolio can closely resemble the market, but with higher costs resulting in underperformance. Each additional fund often comes with management fees, transaction costs, or tax consequences. Even low expense ratios add up when multiplied across many funds. Higher costs directly reduce net returns, especially over long-time horizons where compounding magnifies fee impact. Now, here is the part nobody talks about. There is a comedic version of this trap that I have seen in real life more times than I can count. A guy opens his brokerage app during a family dinner, shows everyone his portfolio, and there are literally 23 different positions listed. He says, "I'm very well diversified." His brother-in-law asks what the biggest difference is between his 3 large-cap ETFs. Silence. The cursor blinks. They're from different companies. That is not a strategy. That is anxiety dressed up as sophistication. And the insidious part is the tax consequence of unraveling it. Because here is where diversification creates its own trap. Once you have realized gains spread across 17 overlapping positions, consolidating them means triggering capital gains events. Profits from the sale of an asset held for more than a year are subject to long-term capital gains tax. The long-term capital gains tax rates are 0, 15, or 20%, depending on taxable income and filing status. At 20% on meaningful gains on a $500,000 portfolio with significant embedded appreciation, simplifying your over-diversified mess costs real money in year 1. The complexity has become load-bearing, which is exactly how the trap works. There's a parable here about a ship's navigator who spent 20 years adding instruments to the bridge. Every new piece of technology was individually useful. Every new sensor made sense in isolation. Then one day, the bridge is so full of screens, dials, gauges, and blinking lights that the navigator cannot see out the window anymore. All the tools meant to provide clarity have collectively produced blindness. The instruments are the obstacle. A handful of well-chosen holdings can smooth out volatility, but layer upon layer of funds and just-in-case investments can blur strategy, water down performance, and leave you with something that looks safe on the surface but quietly undermines your financial future. The cargo ship does not need 20 engines. It needs one good one with the right amount of fuel and a clear course. This is where I want to introduce a secondary story that I want you to keep in mind for the rest of this video because it ties everything together. Her name is Sandra, 51 years old, single, works in project management, built her portfolio from $0 to $500,000 between age 28 and 47 through aggressive saving and disciplined execution. Not luck, not an inheritance, grinding, boring, effective financial behavior, index funds, automatic contributions, minimal touching. At 47, Sandra hit 500,000. She told herself, finally time to optimize. So she did the 3 things we have been talking about. She moved 20% of her portfolio into actively managed funds because she wanted more upside. She hired a 1% AUM advisor because now she had enough to feel like she deserved professional management. And she added 11 new positions to her portfolio because she wanted to be sure she was fully covered across sectors and geographies. None of those decisions felt wrong. Each one was defensible. Together, they shifted her from a cargo ship captain to someone running a speedboat engine inside a cargo ship hull. Let me run the numbers on what Sanders' optimization actually cost over a 20-year horizon at reasonable market assumptions. The behavioral drag from the active trading she started doing with her advisor's encouragement and her own satellite picks roughly 2.5% annually per the Morningstar data on $500,000 over 20 years at 7% base growth. That 2.5% behavioral gap represents the difference between a terminal portfolio of roughly 1.9 million and 2.7 million, a gap of approximately $800,000. The fee dragged from her 1% AUM advisory relationship. A $500,000 portfolio at 7% growth without fees reaches 2.71 million over 25 years. With a 1% AUM fee, it reaches $2.15 million, a difference of $560,000. The tax drag from her excessive rebalancing and the capital gains distributions generated by her actively managed funds, her portfolio returned 10% last year. But after taxes on dividends, capital gains, and rebalancing, she kept only 7%. That 3% tax drag compounds over decades. A $500,000 portfolio can lose $150,000 over 20 years to unnecessary taxes alone. Add these three drags together. Sandra, who did everything right in building to 500,000, is looking at a scenario where her optimization phase costs her well over $1 million across her wealth-building horizon. Not from any single catastrophic event, from compound friction that she never felt on any single day, because it did not arrive all at once. That is the number. That is the actual cost of staying in speedboat mode inside a cargo ship body. This is where it gets really interesting, because the people most vulnerable to these three mistakes are not careless investors. They're not the ones who gamble on crypto or chase meme stocks. The ones at greatest risk are exactly the investors who paid attention, did their research, and developed strong convictions about how money works, because their confidence in their past success makes them resistant to updating their strategy when the math changes. Success creates overconfidence, and overconfidence at portfolio scale is the most expensive bias in personal finance. The second most common mistake among high net worth investors is allowing emotions to drive decisions. Fear and greed often lead to impulsive choices such as panic selling during downturns or chasing performance at market peaks. The market rewards those who remain objective and disciplined. Emotional investing rarely leads to sustainable returns. There's a wonderful absurdity here that I find genuinely funny if you squint at it correctly. The financial industry spends enormous effort selling sophisticated products, alternative investments, structured notes, private equity access, multi-strategy funds specifically, to people above $500,000. The pitch is that your wealth earns you access to better, more complex, more institutional grade strategies. And the data says the opposite is consistently true. The more complex the product, the higher the fee. And the higher the fee, the harder it is to outperform. The sophistication is the cost, not the benefit. The cargo ship that installs the most complicated navigation system is not the one that reaches port first. Here's a quick thought experiment. Take every sophisticated financial product you own above $500,000. The actively managed funds, the structured vehicles, the alternative allocations. Imagine replacing each one with the equivalent index exposure at 1/10 the cost. Now calculate the fee savings over 20 years. If the number is higher than what you believe those sophisticated products have outperformed their benchmark by, and the historical data says, it almost certainly will be, you know what to do. Now, you are asking yourself, what do I actually do? 3 practical takeaways specific to this number and this transition. The first is what I call the stop doing audit. Before you do anything else, open your accounts and convert every fee you pay into a dollar figure. Not a percentage, a dollar amount. Advisor fee, fund expense ratios, trading commissions, any subscription you pay for investment research or tools. Write it all down as an annual dollar total. Then ask yourself one honest question. Would I write a check for this amount today to the entities providing these services? People who do this audit almost always make at least one significant cost change within 90 days. Not because the information is new, but because dollar figures hit differently than percentages. The second is the overlap test. Take your full holdings list and look up the top 10 holdings for every fund or ETF you own. Create a simple running tally. If Apple, Microsoft, Amazon, or Nvidia appears in more than 3 of your funds, you do not have diversification. You have the same stock purchased 3 times in more expensive packaging. The research suggests that below 7 to 9 distinct funds covering genuinely different asset classes, you are almost certainly fine. Above that, you are adding complexity without adding protection. The third is the most counterintuitive. Practice the inactive decision. For every investment move you are considering above $500,000, a rebalance, a new position, a fund switch, ask yourself before acting, what is the cost of doing nothing right now? Not the cost of acting, the cost of inaction. Because below $500,000, inaction has a real cost in missed compounding. Above $500,000, the cost of action is frequently higher than the cost of inaction through capital gains triggered by rebalancing, through transaction costs, through the behavioral price of checking in too often. Tax deferral means being intentional about when you realize gains and understanding the trade-off. You might be tempted to sell an appreciated investment in hopes of moving into something better. But unless your new investment offers significantly higher expected returns, you could end up worse off. Many investors underestimate how much extra return is needed just to break even after taxes. Restraint is a skill. It needs to be practiced. Sandra, by the way, is still in the game. At 51, she has time to restructure. The cargo ship can slow down, reduce drag, and recalibrate its course. The losses are not permanent. They just happen silently, and they will keep happening silently until she makes the update. The update is not complicated. It is not exciting. It does not require a new product or a new strategy or access to anything sophisticated. It requires stopping 3 things you're probably already doing, stopping them specifically, not reducing them, and letting compounding do what compounding does when friction is low. Lazy investing built more fortune than crypto memes, and the people selling you complexity have a financial incentive to make sure you believe the opposite. Over the past 15 years, 89.5% of actively managed U.S. large-cap funds have underperformed the S&P 500, and the industry keeps selling active management. A 1% fee on a $1 million portfolio costs over $500,000 over 30 years when you account for the compounding effect of those fees being pulled from your investments each year. And the industry prices its service in percentages. So you never do that math. 60 to 70% overlap is common among funds in the same category, and the industry sells 17 fund portfolios as diversification. The amusing thing about all of this is that the fix is almost nothing. You stop doing 3 things. You pick a simpler structure, you let the engine run, the cargo ship loaded correctly, moving steadily with minimal drag, and a clear heading wins by enormous margins over any speedboat that keeps trying to outmaneuver the route. The number is 500,000. You have either hit it or you are heading toward it. Either way, now you know what changes when you